Thanks for the introduction. Thank you very much for the introduction. I want to make sure that part got on the recording. Can you still see my screen?
Yeah.
I can see your
You
screen.
can still, okay, no, it just something changed on my screen, so I just wanted to make 100% sure everybody could still see the presentation. That's all.
Yep.
All right, cool. So I want to talk about what the title is there, that just drug development and something within the capital markets that matches up quite well with the economics behind creating a new drug. And I think most people in the world are a lot more familiar about the drug trial process than we've ever been because of how things got sped up with COVID. And doing some research on this, it's just amazing the number of papers that pop up about circumventing some things to get COVID, to get our jabs approved so we can go on with our lives. So I'll talk about the clinical trial process a little bit. That's more the attendees' expertise than mine, but then I'm going to talk about the capital markets and how all types of businesses use the capital markets to raise funds. But what probably works best, at least in my mind, when you're raising money to go through to fund a drug trial. Now, as we mentioned, just as we were chit-chatting at the very beginning, I'm just starting my second year here at Kelly. I'm associate clinical professor of financial management. I always have to have that written down on a sticky note because it's a long title. I was with the Chicago Board of Options Exchange, which is one of the derivatives exchanges, for about a decade, and I ran the education department there when I left. I've also been at Loyola, Chicago, Benedictine, UIC, Carthage College, and when I was with SIBO, one of the things I did was higher ed outreach. So I've guest lectured at just under 100 schools. I was kind of bummed I never hit 100. Before that, I actually worked with buy-side firms, which means firms that actually invest on your behalf. If you have money in a Fidelity mutual fund, for instance, Fidelity would be considered the buy-side firm because they invest on your behalf. Brokerage firms are considered sell-side firms. Most of that experience was on the hedge fund side of things. And then about the great financial crisis, decided to switch over to education, which I kind of wish I'd just started out in education. So the clinical trial process and this time frame can vary based on lots of different factors. So these numbers are pretty general. Just the stage one is discovery and development, then do preclinical research, and then go through the clinical research process. And these odds of success I got from the FDA, and I believe that the data comes from 2000 through 2019. So these numbers can vary from period to period. But 70% of the time you're going to get past stage one, 33% of the time past stage two, and then 25% of the time you're going to get past stage three. So in a very basic way, and I've seen other numbers like this thrown around, you could say that 25% of the time that a pharmaceutical company embarks on some sort of clinical trial process or trying to discover a new drug, their win rate's only going to be 25%. And that is, if you're thinking about it from an investing standpoint, or I hate to use gambling, but our gambling standpoint as well, and you've only got a 1 in 4 chance of being successful, and I'm referring to, I just want to make sure people are looking where I'm looking. I'm referring to this number right here, this 25%. Well, if you're a large pharmaceutical company and you have 4 trials going on right now, you may make a financial assumption that only one of them is going to pay off. And you would take that into account as an investor. If I'm investing in something that only has 1 in 4 shot of paying off, although it might pay off quite nicely, I want to be compensated for that. And when I say compensated for that, you want an awful lot of upside because that's a risky proposition. So I just saying 3 to 6 years to market, depending on all the science behind the drug approval, drug approval process. So, as I mentioned, only 25% of drugs make it to approval. I also saw a figure that said right around only 5% actually are standalone profitable on their own as well. So it's a lot of work and a lot of funds going into things that fail more often than I think a lot of people would realize. The average cost for a failed drug trial, I saw figures anywhere between 900 million and 2 billion. So I decided to stick with the 1.5 billion. Also kind of nice round numbers to work with as well. So if you do the simple math here, 25% of drugs are going to make it to the approval, and we'll assume that we're going to sell that 1 in 4 that makes it to approval. You could back into the average cost for each drug that goes to market is 6 billion in R&D, because you're going to spend 1.5 billion each time on average. You're going to end up spending 6 billion for each win that you get there. So if you're thinking about investing in a startup drug company that's only got one drug in development, you may want to take into account the odds of never really getting paid off on that drug that is in development.
Hey, Russell, it's Kim.
Yeah.
A question.
Thanks, Kim.
Are there certain classes of drugs that are more likely to gain approval versus others?
Not necessarily more likely to gain approval than others that I've seen, but there are some that, and this is where the science gets past me. There are some where the trial, it may be a reuse of a drug that's already out there to try to get an extension on the patent, and the cost behind something like that would not be as great as the cost of something that's being developed from scratch.
Right. Additional
Mhm.
indications are a lot cheaper and a lot more likely than the first
Yeah.
indication.
Exactly. You're gonna carry me on your shoulders a little bit today.
No worries. We're here to help you.
Feel free to step in. And this is when a drug company is taking into account how much they spend on R&D, and I was really surprised the numbers that I found on the next slide. What do you think the new drug's gonna what are the expected revenues going to be? What's going to be the development cost? And then you always have to keep this one in mind right here. And I'm very apolitical when I talk about anything, but anything that changes is with respect to the FDA, anything that changes with laws that maybe force the pharmaceutical industry to put a cap on certain prices, those things need to be taken into account as well. And that's very much of a gray area. I think the expected revenues and the expected cost to develop a new drug, both of these come from experience. When I teach any level of finance class, and we start introducing valuation metrics, I often get the question, well, where did that number come from for evaluation? And typically that number comes from what has been the historical valuation for a company. So same thing with respect to drug development, looking at maybe similar drugs that had similar markets for the expected revenues, and then just what have the internal costs been in the past. So, right. And I just saw, Jenna, thank you for the question. I just saw you were the one that asked that question. There we go. So, and this was really, I got this from the Congressional Budget Office, and I thought it was first off, I never would have thought software spent a higher percent of their revenue on R&D than pharmaceuticals at any time. I always felt like I would have guessed that pharmaceuticals would have been at the top of this list through all of history, but this has been more of a something that's kicked off since the mid 2000s, where more pharmaceutical companies are spending more of their retained earnings on research and development than other areas that you would think of as needing to try to stay ahead of their competitors, semiconductor software and then technology. all industries is just all of the S&P 1500 stocks. And on average, they spend a little under 4% of revenues on research and development, whereas pharmaceutical companies spend, and again, this is up to 2019. It'd be really interesting to see 2020 and 2021 with what's been going on, but about a quarter of their sales. This is not a quarter of profits. This is a quarter of sales that on average in the pharmaceutical industry is spent on the drug development process. So where do we get the money? Well, in the most preferred source of funds for any company is number one up here, which is retained earnings. How much after a company has closed the books on a year and paid dividends out, how much of their earnings after paying out dividends have they retained to continue to run the company? And for a research and development heavy industry like pharmaceuticals, you would expect a good portion of earnings to be retained relative to other industries. Now, something I'm not going to really touch on because I'm talking about the capital markets. Of course, there are all kinds of grants out there that help seed different types of different drug trials. But the business-wise one, the one that needs to be tapped one way or another by industry is the capital markets. And we'll talk about 3 ways that you can raise money in the capital markets, and then talk about how one is uniquely qualified to for a drug trial, and because you get some of the upside and you also get some income over time. I think when we think of public companies and we think of gaining exposure to a public company, the one that everybody's familiar with is just buying shares in the company. And when a company, we know what an initial public offering is. It's when a company that's private issues shares for the first time on one of the stock exchanges. And that's an IPO, or when the company goes public. But after a company is public, they can actually have the ability to issue more shares if they feel like they need more capital for business purposes, or if they just want to take advantage of market conditions. So a public company can file for a secondary offering, which stockholders tend to not. It depends on the use of the funds, but typically when a company issues more shares, that means that they are diluting the ownership of current shareholders, and they need to have a pretty good reason for that. So companies that issue more shares, they're conducting a secondary offering. The market tends to not like more shares. They tend to like when companies are buying back their own shares as opposed to offering them, and again, unless they have a really good use of the capital. As far as for drug development, it's a big positive here is if they can easily issue stock and they've got a strong history of drug development, if they've got a lot of supportive investment banking firms, I think that would help as well. But the investor payoff, it can be pretty substantial based on what they're trying to do as far as the drug goes. The con is it's long term. If you're looking at a company that's embarking on a drug trial today, and that's why you're thinking about buying the stock, it may not show up in the stock price for 3, like I showed earlier, for 3 to 6 years or so. The investing public does not have that patience anymore. I think the average hold of a stock by an institution is 18 months right now. So even though it makes an awful lot of sense, if you think a company's going to profit greatly from curing cancer or something along those lines, it makes a lot of sense to maybe want to own stock in that company. But you definitely have to be in it for the long game, and investors are just not as long-term focused as they should be. So bonds are another way that companies can raise funds. Typically, the first time a company goes to the financial markets and raises capital, it's through an initial public offering. And then after they've established themselves a bit more, they will have the ability to issue bonds. And bonds, it's a cheaper way for companies to raise funds. There's a internal tax break that they get on the bond coupon payments that they're having to make. The issuing cost can be less than issuing shares. It also does not necessarily have the same high profile negative impact on the share price as issuing shares and diluting the stock, as opposed to just issuing bonds. If you buy a bond from a company, you are actually acting as the bank and you are lending them money. I'm gonna give a real basic example of this in just a second. And what you get is you get annual interest payments from them. I'm just doing a payment once a year to make the math pretty simple. And then at the end of the life of the bond, you get your capital back, typically $1,000. And that's typically the face value of a bond. So Drug Co., they're going to issue bonds at the end of this month. And I put a face value of $1,000, maturity. So of 5 years, you would get your $1,000 back. Coupon rate is 4%, and you get annual payments. And this example is if you buy the bond directly from the company, you are giving them use of that $1,000 over the next 5 years. And the drug company believes that they can do better than that 4% coupon rate on whatever they're going to do with those funds. So my very basic bond example here, these are the cash flows. We bought the bond, or we lend $1,000 as the investor to the drug company. So we had an outflow of $1,000. And then over the next 5 years, we get a $40 interest payment. Excuse me, I'm more of the equity world, so I almost called it a dividend, but a $40 coupon payment. And then we get our $1,000 in one more coupon payment at the end of the 5th year, 2027. Now, think about this from the perspective of the drug company. We've given them $1,000. Now they've got, and lots of people have given them $1,000. And so now they've got some capital to spend on the research and development of whatever drug they're thinking about trying to move forward with. They do need to set aside some capital to make these interest payments, these $40 interest payments each year, but using a 5-year bond to fund a drug trial like this, we would assume that we're going to start making profits off of the drug in 2027 and be able to pay back the principal to the bondholders. Excuse me. So that's why a fixed income instrument makes sense with respect to raising capital for drug development. You kind of have a time frame in mind, and you have a period of time where you've got that capital to work with. That's a positive for the firm. Bond issuance is less expensive. That's another positive. Here's the negative. If you are, if you're receiving interest payments and principal at the end of the bond's life, but you're not really getting to participate in any real upside if the drug is very successful. So it's kind of like, I don't know, lending one of your friends a few $100 who's trying to start up a small business, and they hit, they're the next Meta/Facebook, and they only give you a few $100 back and maybe a little bit of interest. So, and you've lent them money for a pretty risky prospect. So issuing bonds with respect to directly funding a drug development project, those folks that are thinking about buying those bonds, they're going to want a lot more than 4%, like I showed on that previous example there. They're going to want, they're taking on an awful lot of risk for a kind of a small payoff there. Excuse me. So this turns to something called a convertible bond, and convertible bonds are great for companies that are still in a startup mode that need to borrow some money because they don't have to pay as high of coupon payments to the purchasers of a convertible bond, but they do offer shares in the company that at a certain price, where the buyer of a convertible bond can actually benefit if we've got a blockbuster drug here and the stock price takes off to the upside. But in the meantime, the purchaser of a convertible bond would also receive interest payments. So my basic convertible bond example, and we're looking at the same time frame here. Do note that I highlighted the coupon rates a little bit lower, and that's because we get, if we buy the DrugCo convertible bond, we get the right to convert our bond into 100 DrugCo shares. And I'm not putting any time frames. I'm trying to keep it very basic here. So right now, if we were to buy this bond, we would give them $1,000, and we would get coupon payments of $30 a year for the next 5 years. But we also have the ability to convert the bond into 100 shares of the drug company, which would be more attractive if we're looking at something that we're hoping is going to hit a home run at some point. Here are the cash flows. And the main thing with respect to the cash flows is you can see it's a little bit cheaper for the drug company to raise money this way, only having to pay $30 a year in interest. They may, and this is something that I think they would probably want to do, but remember, this bond is convertible into 100 shares of DrugCo. You take the convertible security to your broker and say, I want to convert this into shares, and you end up with 100 shares of DrugCo. Well, at $9 a share, that's $900 worth of stock. But let's say 3-4 years down the road, it looks like they've got a very promising drug. People are starting to pay an awful lot of attention to DrugCo, and the stock price is well above $10 a share. At that point, we may consider converting our bond into 100 shares of DrugCo, and then turning around and selling those shares in the marketplace. Excuse me. So the convertible bond, it allows for, as I mentioned, exchange for 100 shares of the stock. We would expect that we want the stock well above $10 a share. And at that point, you can get your 100 shares. You can sell the shares in the marketplace or continue to hold them, continue to hold the shares if you have a strong belief in the company. So got a good question from Mohammed. Is the minimum coupon payment insured by the company or itself, or a third party, or even a federal agency? So the coupon payment is when I'm going to go back to the basic bond. So when we take a look at this bond here, the 5-year bond that's issued on August 31st this year, and that matures in 5 years, that each of these pieces of information are part of what we call the bond covenant. And what my basic bond is doing here is it's saying, if you give us $1,000, we'll give it back to you in 5 years. There's, promise of 5 years. We're going to pay you 4% a year. So when you're asking about the minimum coupon payment right here, it's set by the bond covenant. And it also says how often you'll get the payments. Now, if the repercussions behind this is if the company misses a coupon payment, and this can vary from company to company as well, but that in a roundabout way is putting them pretty close to some sort of restructuring or bankruptcy. There's a lot more to it than just what I just said. But so the coupon rate, if they miss a coupon payment, they may have a grace period, or they may try to renegotiate with their bondholders to, much like you might try to refinance your mortgage sometimes. They may try to do something along those lines. But if they miss that coupon payment, there are repercussions, that they're going to have to deal with respect to the bondholders, because they have promised all of these things and they have broken that bond covenant. So that's where, and you were saying the minimum coupon payments, it really is a market rate. That's the bond brokerage firms will approach, investors, maybe investment firms that like to specialize in the healthcare space and they like convertible bonds. You might hit up those buy side firms that are specifically invested or interested in that area. And before you even decide what coupon payments are going to go along or what the convertible part of the bond might be, you get a feel for what the investing public would be willing to pay for those bonds or what kind of return they would expect from those bonds right now. So the coupon payment, the really short answer to your question would have been it's set by the market. But it's set by the market, but then it's part of the bond covenant or the promise that is being made to you when you lend your money to the company. So specifically in drug development, it's a pretty risky process. Every firm that I worked at, and I don't, if there are any practicing doctors, we need you, so don't do this. But every large hedge fund I worked at, we had somebody that was a former physician that helped us with all the science on the investing that we did. And they said they liked it a lot better than, they just weren't people like us. So do keep in mind, if you're just purchasing a stock for a drug payoff, it might not pay off for years. There was without getting too specific on it, there was a company in southern Wisconsin that came up with some neat testing abilities, and it took them about 4 years to get an approval. I think the stock went from like 50 to about 7 to about 200 over the whole life of them going through the trial process and the rumors and everything else. So purchasing stock, it might not pay off for years, but it can also be a very volatile type of situation. Bonds, they offer you steady income. You've got a covenant that tells you what you're going to get, but you may not, if you are purchasing a bond that is not convertible into a stock, you're not going to really be able to participate in the profits. And convertible bonds, I feel like they offer the best, best for bonds and some upside participation as well. I think in outside of the healthcare space, but a company that used convertible bonds very effectively, and I think just about everybody converted their bonds into stock now is Tesla. When they needed capital to kind of reach profitability. And the way that they went to the market was they used convertible bonds. They kind of took advantage of that cult-like status that Tesla has among some investors, and that helped them borrow money at a lower rate as well. So I think I'm a minute shy, but I did answer the question that popped up there. I think I will field any more questions that anybody has.
Thank you, Russell. Really appreciate it. I had never really thought about it in these dynamics. I have to admit that I did sit on Lily's portfolio management committee a couple of times and was responsible for doing some of those expected revenue and expected costs. And so that was a different, you're right on. There were a lot of issues that we were trying to work through. It probably took us 2 weeks to get those calculations ready for that meeting, because a company like Lilly is looking across its portfolio and trying to understand where to best hedge its own bets as well to make those returns, but never thought about how they financed it. So that was really super helpful. Any questions for Russell at this point? I see some nice comments in the feedback. Otherwise,
the conversion offer, it's not necessarily, Mohammed, I'm going to rephrase the question just a little bit. You're saying, doesn't the conversion offer mean the company foresees more risk in the future to the profit? No, the conversion offer is more of it's a way for a company to raise funds and lower the costs a bit up front. And that's why when I almost wish I had put these side by side, but I did this little table of the cash flows if you bought the convertible bond where we got paid a little bit less. We get paid a little bit less, and this costs the drug company a little bit less because they are, they're giving me the ability to participate in the upside. And that's one of the big benefits to a company that issues convertibles is they're lowering their upfront borrowing costs. They are going to have to issue they would have to issue shares if the stock starts to take off to the upside and convertible bondholders start to convert to shares. But part of the positive is that's exactly what they want to happen, because that means that their drug is successful. They're making pretty good profits. So they're hoping that the stock goes up enough that a lot of people convert into shares.
Well, Russell, I have one last question for you to think about, and I haven't prepared you in advance. So I realize with, COVID mind and all that, it might be a tough one. I recently saw a statistic that said that the number of clinical trials in the United States was going to double over the next 5 years. So
that's on trend.
Yeah,
it really is. Where is that? You're making me pull reports and whatnot. But that's a trend that has been in place. Actually, I'm going chart.
Yeah, it's a hockey stick graph.
Well, but these are the number of approvals and by decade, and you can see that that to the far left there, or by 5-year periods. So back in 2005, 2009, we had 22 approvals, and then we just had 45 in the last 5-year period. So the number of approvals has gone up tremendously as well. I do think that companies it seems like the government's doing more to help with the funding process than it had in the past, than when I covered these things as an analyst, as I got back up to speed. So I was kind of surprised to see how much comes grant wise, because it used to not be like that.
Well, I was just thinking, if you look at that total portfolio across the pharmaceutical industry and the riskiness and the cost, it's really mind-boggling how much is being invested in the future of our health system.
Oh yeah. It's I think it was I somewhere between 80 and 90 billion next year is a number that's sticking in my mind right now.
Sounds about right. All right. Well, Russell, thanks so much for your time today. We appreciate you educating us more on the bigger picture of pharmaceuticals and how companies finance these undertakings. For folks who have joined us, we'd love to have you in our graduate certificate in medical management, where you can learn how to practice these skills yourself in order to support your own initiatives moving forward. Please feel free to reach out to Russell. Russell, do you want to go back to your email with any future questions? And thanks for spending part of your lunch hour with us today. Appreciate all your time. All right. And with that, we're going to let you get back to your day and say goodbye.
Thanks a lot, Kim. Hopefully I'll see you next week.
Hopefully. All right.
All right. Thanks.
Bye.